The book One Up on Wall Street by Peter Lynch, one of the legendary investors, has brought investors profound and easy-to-apply lessons on how to evaluate and invest in stocks. Peter Lynch not only shares investment strategies but also emphasizes the importance of careful observation and analysis in finding attractive investment opportunities. Below are important lessons from the book One Up on Wall Street, divided into sections to help you easily understand and apply. 1. Invest in what you know. One of the basic principles that Peter Lynch shares in the book is invest in what you know. He believes that successful investors are often those who invest in companies that they understand well. This helps them identify opportunities as well as potential risks that others may overlook. Use everyday knowledge. Lynch believes that smart consumers can spot potential companies through the products and services they use every day. If you see a product with great potential, find out if the company that makes it has the potential to grow. Understanding companies, understanding the company, its industry, and its operating factors makes it easier for you to make accurate investment decisions. Lesson: use your own knowledge and experience to find investment opportunities. Don't be afraid to invest in companies you know well and have real-world experience with. 2. Look for companies with long-term growth potential. Peter Lynch always focuses on investing in companies with strong and sustainable growth potential over the long term. He doesn't look for stocks that have immediate value, but companies that have the potential to grow strongly in the future. Analyze growth potential. Lynch encourages investors to look for companies with a competitive advantage, a unique product, or a business model that can expand and thrive over the long term. Pay attention to growth factors to identify companies with growth potential. You need to pay attention to factors such as innovation, expansion strategies, and management's ability to manage the board. The message: look for companies with long-term growth potential and strong growth potential, rather than just looking for stocks with short-term profits. 3. Don't be afraid of small stocks. Peter Lynch is a strong advocate of investing in small-cap stocks, companies with low market capitalizations. According to him, these stocks often have strong growth potential in the future and are less likely to be noticed by large investors. Opportunities from small stocks. Small companies can easily develop and grow quickly, because they are often in the early stages of development, not yet dominated by the big guys. The ability to find hidden gems. Small companies may not be properly valued by the market, providing great opportunities for smart investors to discover their potential. Lesson: don't ignore small companies, because they can bring huge profit opportunities when they mature. Look for and invest in small stocks with great potential. 4. The importance of understanding financial ratios. An important factor that Peter Lynch always emphasizes is the use of financial ratios to evaluate the health and potential of a company. Metrics such as P/E ratio, price-to-earnings ratio, profit margin, free cash flow and debt level will help you better understand the financial situation of the company. P/E ratio: this ratio helps you understand whether a company's stock is reasonably priced. A low P/E ratio may indicate that the stock is undervalued relative to the earnings the company generates. Free cash flow and debt: companies with stable free cash flow and little debt are more likely to weather market fluctuations and maintain growth. Lesson: use financial ratios to assess the health of a company. Understanding these ratios will help you make informed investment decisions. 5. Invest in companies with a clear path. Peter Lynch advises investors to look for companies with a clear path. These companies have a clear business strategy, know their long-term goals, and have a specific plan to achieve them. Easy-to-understand business model: a company with a clear path usually has a simple and easy-to-understand business model. These companies typically do not have much complexity in their business and can focus on achieving long-term goals. Strong leadership: the company's leadership must have a clear vision and the ability to steer the company in the right direction. Lesson: invest in companies with simple business models, strong leadership and clear strategies, as they are likely to grow steadily and sustainably. 6. Patience is the key to success. Lynch emphasizes that one of the most important factors for success in investing is patience. Investors need to understand that the value of a stock does not always immediately reflect what a company is actually achieving. Be patient and wait. Just because a stock does not immediately achieve a high value does not mean that it is not good. Potential companies may take time for the market to realize their true value. Long-term investment, patience and long-term investment are the methods that Peter Lynch has applied to achieve great success in his career. Message: patience and waiting are the keys to your investment success. Long-term investment will help you gain great profits from potential stocks. Conclusion: Peter Lynch's book One Up on Wall Street is a valuable document for investors, especially beginners. The lessons from this book, such as investing in what you know, looking for companies with long-term growth potential, and being patient in your investments, are extremely effective strategies for success in the world of investing. Apply the principles shared by Peter Lynch to become a smart and successful investor. Key message: invest in companies you understand and believe in. Look for companies with long-term growth potential. Be patient and always invest for the long term to take advantage of profitable opportunities.